when they are released by companies. Getting familiar with database that allows you to access financial information. By now, your financial calculator or spreadsheet is probably fired up and ready to start crunching down fundamental data. There is just one little problem. You need to get the data first. Here is the good news. Getting your hands on financial data has never been easier. So, there has never been a better time to be fundamental analyst. You are able to get the data faster, at less cost, and with less technical expertise than ever before. The ability to obtain financial data most immediately from companies and for free allows fundamental analysts to closely monitor how a company is doing. This chapter will show you what types of fundamental data companies provide to investors, what form they come in, and where you can expect to get them. You will also get a quick refresher on accounting basics you will need in order to understand what's contained in the report when they land. Finally, this chapter will show you how to obtain financial data, including a detailed look at the treasure trove of fundamental data provided by the nation's top financial corp, the Securities and Exchange Commission or SEC. Getting in sync with fundamental calendar. Companies you can invest in don't get to decide whether or not to give you their financial information. It's not a choice, it's an obligation. Trust me, that's good thing. Just imagine how haphazard it would be if companies could choose what and when they would tell their investors how they are doing. What if companies just were not in the mood to report their revenue or earning in a quarter? If a retailer had a bad holiday selling season, for instance, it would tell investors, sorry, we are not going to tell you how we did. Such selective disclosures would be corporate version of letting your kids only bring report card home if they got all A's. In reality, in reality, publicly traded companies agree to be somewhat transparent. Transparency is a popular buzzword in business, and it's a noble goal. To be transparent, companies must adhere to strict rules about what financial information they disclose, and must even meet strict deadlines in getting fundamental data to investors. This goes for nearly all publicly traded companies or those that sell ownership stocks of themselves to the general public. Similarly, when companies borrow money from the public, they too must disclose their financial result to the public. Remember, by taking the public's money, companies agree to give investors quarterly update on their financial progress. Access to current and accurate fundamental data is one of your most basic rights when you either invest in or lend money to a company. Which companies must report their financial to the public? Just about any company you can invest in must follow financial reporting rules. That includes companies that are publicly traded as explained above, but even some private companies which have not sold stock must provide some financial information if they have $10 million or more in asset and have 500 or more owners. Most major stock market exchanges, including the New York Stock Exchange and Nasdaq, require their listed companies to provide quarterly and annual financial reports to investors. That includes foreign companies with share of stock that traded on either exchange. Tip: some private companies offering generous stock options program to employees often find themselves eventually having to start filing financial reports. Internet search company Google, for instance, was private for roughly 6 years after it was founded in 1998. The company quickly hit the $10 million threshold for total asset, meaning it was required to provide financial statements. At that time, Google decided it might as well become publicly traded and sell shares to investors in an IPO because it was going to have to report its financial statements. Google launched its IPO in August 2004. No data is bad data. If a company claims to be publicly traded but does not provide financial information, be highly skeptical. The lack of financial information is especially critical when dealing with a stock that traded on the lightly regulated market known as the OTC Pink or OTC Bulletin Board. The OTC Pink market is often nicknamed the Pink Sheets. Unlike regulated exchanges like the NYSE and NASDAQ, stocks that traded on the OTC Pink are not required to provide any financial information to investors. You read that right. These companies may even have ticker symbols, but never disclose how much they made or even how much revenue they generated. Most of the stocks on these markets are lightly regulated, if at all. Companies that trade on the OTC Bulletin Board must disclose current financial statements but are exempt from other investors' protections such as market value minimums. The lack of financial information is a huge reason why investors, especially those who rely on fundamental analysis, are often best served by avoiding stocks that traded on the OTC Bulletin Board or OTC Pink. These markets are infamous hangouts for so-called penny stocks. These stocks, which generally traded for a few pennies, are often just a name and little else. Sometimes penny stock companies claim to have product and a management team but don't actually generate any money to speak of. Penny stocks are popular with speculators who like to talk up a sale company's prospectus, get investors excited enough to buy in and then dump the shares for a quick profit. Kicking it all off. Earnings season. A sports fan wait all year for the beginning of football, basketball, or baseball season. Children can't help but anticipate the holiday season, but it's earnings season that fundamental analysts look forward to. 4 times a year. Shortly after the end of the quarter, companies will begin to report their financial results to investors. Because most companies are on a calendar year, the results generally start kicking out 2 weeks after the quarter ends. 4 times a year, usually in January, April, July, and October, thousands of companies report their financial results en masse. These times of year are called earnings seasons. Tip: Aluminum maker Alcoa earned the unofficial designation as the company to kick off earnings season. The company's advanced accounting system allows it to close its book very rapidly following the end of the quarter. Alcoa for years was the first stock in story Dow Jones Industrial Average to report its earnings each quarter. Alcoa was kicked out of the door by show maker Nike in 2013. But even to this day, many investors see Acola's growth too as the start of earnings season. Hello. हाँ. हम्म. ठीक है. हम्म. ओके. हम्म. हम्म. हाँ. हम्म. ठीक है. ठीक है. हम्म. 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 ओके. ये एक्सेल पे बनेगा ना? अच्छा वर्ड पे बनाना है और करते हैं। हम्म, ठीक है। हम्म। ओके। हम्म। हम्म। ओके। हम्म। हाँ। हम्म। हम्म। हाँ। हम्म। ठीक है। ओके। ठीक है। हम्म। हम्म। ठीक है। ठीक है। हम्म। ओके। Tip. Look for remember. Not all companies follow a calendar year. For instance, retailers generally bring in a vast majority of their sales each year during December. For that reason, many retailers close their books at the end of January to give them time to tally up their performance in December and give a full report for the year. When a company ends its year for accounting purposes in a month other than December, it's called a fiscal year. Getting the earnings press release. You don't have to be a journalist to appreciate the earning press release. Contrary to its name, the earning press release for all investors, not just the media. When it's time for a company to tell the world how it did after the quarter ends, the first move is to issue an earning press release. The press release is usually, but not always, accompanied by a conference call for investors and analysts. During the call, the management team will go over the quarter or year, describe the information in the earning press release, and answer questions from the analysts who cover the company's stock for research firms. Tip: when you read or hear a company reported its financial results, the information almost always comes from the company's earning press release. While earning press releases are technically unofficial and preliminary, they are usually accurate enough for investors, analysts, and news media to use the numbers immediately. It's important to remember, though, that the earning press release is not reviewed by an accountant or auditor. When companies issue an earning press release, they will often notify the regulators by filing a Form 8K. The 8K filing is the official way to signal the world that the company has released critical information. Regulators do not directly stipulate what companies must say in earning press release, but generally, earning press release contains several key parts. Summary of the result. Most earning press release will give the numbers investors want most right at the top, maybe even in the headline. That includes the revenue and earnings the company generated during quarter and how much it grew or shrunk from the same quarter last year. Be leery when a company brags about a quarter being a record quarter. Even if a company's revenue rose to a record amount, its cost may have also run out of control and eaten into its earnings. Management comment. A member of the management team will usually opine on how the quarter went. As you might imagine, these statements are generally very carefully crafted, overlay optimistic, and not particularly useful. Description of major business events during the year. Companies might break down and even provide succinct bullet points of the major accomplishments during the period. Guidance for the future. Most companies will often provide earnings guidance or an estimate on how much the company might earn in the upcoming year or quarter. This guidance is important because it lets you know what the company expects in the near future. Financial statements. The earning press release is the first glimpse investors will get of company's income statement and balance sheet. These statements are among the most critical documents for fundamental data you will get. Tip. It's a good idea when reading an earning press release to bypass most everything except the financial statements. While earning press releases are intended to be honest representations of a company's performance, companies use the first part of the earning press release to put their performance in the best light. In contrast, the financial statements are the purest and least biased parts of the press release. Bracing for the 10Q. Following the earning press release, the next document to trickle out from the companies is the 10Q. The 10Q is the official financial report submitted by a company to summarize its performance during the year. Most companies have 14 days from the end of each fiscal quarter to produce and provide the 10Q to investors. Generally, companies file the 10Q a week or after they provide the earning press release. You can see the deadline for the key financial document in table 4.1. Tip. Both the earning press release and 10Q serve the same basic purpose. They tell investors how the company did financially during the quarter, but because the 10Q is written primarily to satisfy regulatory requirements, it's usually much more straightforward and contains less spin. The 10Q must be filed with the chief regulator of the financial markets, the SEC. As a result, companies are careful to include the following key components. Financial statements. Companies don't waste any time getting straight to the point with the 10Q. The key financial statements are represented right at the top, while they are usually at the bottom of earning press release. Don't make the mistake of assuming because you read the earning press release you don't need to bother with the 10Q. The 10Q usually goes into greater detail than the press release, not because companies feel like spilling the beans, but because these documents are filed with the regulators. For instance, a vast majority of companies don't include a statement of cash flow in the earning press release. The statement of cash flows, however, must be included in the 10Q. As you discover in Chapter 7, the statement of cash flow is an extremely important document used in financial analysis. Footnotes. Just as some books just don't fit correctly in your bookshelf, some financial information does not slip nicely into the financial statements. Unusual or noteworthy financial events might require more description then will fit into the financial statements, and those are available in footnotes in the 10Q. Never skip the footnotes. Companies will often throw items in the footnotes hoping you will miss them as an investor. Remember, in Rome, the energy company that failed in 2001, that was one of the biggest corporate fraud in US history. The company suffered much of the information about its cryptic partnership in the footnotes. Management's discussion and analysis of financial condition. This section of the 10Q is usually called the MD&A. In the MD&A, management steps investor through its financial results for the quarter. The narrative is usually stripped down and well straightforward because executives know the SEC will review it, so they don't want to say anything that may haunt them later. Controls and procedures. The company will let investors know if they found any problem in the way they monitor their accounting and present the information to investors. Following the accounting scandals at Enron, new rules from the Sarbanes-Oxley Act of 2002 forced companies to make sure they had adequate controls in place over their accounting. Many companies fought tooth and nail to avoid these rules. You might as well read them. Other information. Here, company can throw in the other material that might be of note to investors. This may include any pending litigation or whether the company sold additional stock or is having trouble paying interest on its debt. Many investors don't realize a company's 10Q is not officially audited by a third-party accounting firm. That does not mean you can't necessarily trust the numbers. Just know a little more skepticism is not a bad idea. Running through the 10K. If you have ever run a 10K race, you know that it can be pretty grueling if you have not trained properly. The same goes for companies looking to report their annual financial performance in the form called the 10K. This document is a monster, and producing it is one of the biggest financial chores a company faces. It's also the most comprehensive piece of fundamental data you will get as an investor. Most companies are required to release their 10K filings within 75 days from the end of their fiscal year. Some smaller companies, though, have 90 days to comply with the rules. Remember, due to the complexity of producing a 10K, there can be a significant delay between the end of the calendar year and the time the report gets released. The 10K is a kind of like a company's annual review. The level of details of the 10K is exhaustive, and unless you know what you are looking for, it's easy to get lost in the hundreds of pages of table and text. That's why fundamental analysts rarely curl up with the 10K and read it from start to finish like a novel. They just know how to skip around in a 10K and look for these key elements. Everything in the 10Q just for the whole year. All the data you get in the 10Q for the quarter, you get for the year in the 10K. That includes the financial statement and legal proceedings, but also more explained MD&A, where the management team explains more fully how the year progressed. The controls and procedures sections may also be more fleshed out because the 10K has been checked over by the auditors. Changes in accounting and disagreement with accountants. You might not expect to see conflict and intrigue in a company's financial reports, but sometimes you can find it here. Companies and their accountants will state in this section whether or not they did not see eye to eye on financial reporting matters. Long-term financial data. Companies give you the financial results for the year that just ended, but you will also find data for the past 3, 5, or even 10 years. These data are very useful when looking for trends or changes in fundamentals like revenue and earnings. Business summary. Here, the company lays out the nitty-gritty of what it does for a living. The company may break down its major business units and even, in some cases, tell you which part of business are the most profitable. You will find how to study the profitability of a company's units in Chapter 5. Risk factors. Imagine showing up to a quick to pick up a date, but before you leave for the movies, he or she sits you down with a huge list of everything that's wrong with themselves. That would save quite a bit of time. Yet that's precisely what companies must do in their 10Ks. If there is a known factor that could impair a company's fundamentals, it is required to tell you about it here. Auditor's opinion. Close to the bottom of 10K, the accountants will need to sign off on the books to indicate they reasonably reflect the financial condition of the firm. Tip. When reviewing a 10K, always read the auditor's opinion. The statement from the auditor can be telling. Why an auditor may not wave a red flag and tell you not to buy stock. You can read between the lines. For instance, if you see the word qualified, watch out. That means the auditor has some issues with the way the books are kept, so you should too. Also, be careful when an auditor says a company may not be able to remain a going concern. That's accounting talk for this company might not make it. Flipping through the annual report. If you visit a CEO's office, you will find C. The annual report sitting on the coffee table. Some companies' annual reports are gorgeous. Well, as much as financial documents can be. The annual report is essentially the 10K, but formatted like a magazine. There might be lovely photos expanding executive employees and customers. Even the financial statements are giving a fancy lift, usually printed on luxurious paper using an elegant font or in a fancy website. The annual report is usually released several months after the 10K is published, often landing around the time companies have their shareholders meeting. Tip: unlike the 10Q and 10K, which you can download directly from the SEC's website, the annual report is often directly from the company either through the mail in paper or on the company's website. If you can call a company, it's usually happy to mail you a copy. You can also usually view an electronic form of the paper annual report by downloading it from the company's website. The annual report is the glossy and slick version of the 10K. Companies produce the annual report mainly to hand out to employees and customers while quoting them. The annual report is the management team's opportunity to put its spin on how the year went. Most annual reports, for instance, begin with a letter to shareholder that is generally very hopeful even after a dismissal year. There is no proxy like the proxy statement. If you are looking for the most salacious statement released by companies, that must be proxy statement. The proxy statement is a document the SEC requires companies to distribute to shareholders ahead of the annual shareholder meeting. It's a kind of like the absentee ballot you might get prior to a presidential election. Shareholder meeting happens every year as companies gather shareholders usually in the spring to go over their initiative and goals. The proxy is sometimes known by its regulatory name 14A, named after the portion of the SEC rules that stipulate what it must contain. The proxy statement is fascinating reading because it lays out all the most sensitive information most companies have to offer, including executive compensation. You want to find out how much a CEO gets paid? The proxy is your recommend. Not only are the annual salaries of the top executive spelled out, but the amounts of their bonuses too. Corporate matters subject to a vote. Companies' proxies contain a section that looks almost like a ballot. There will be a number of measures that require shareholder approval. Usually the item up for a vote include the selection of the auditing firm and the board members standing for election on the board. Shareholders' proposal. If a company has any ill will with shareholders, it will become very clear in the proxy. Dissident shareholders may offer proposal to replace the management team. Other investors might lobby for the company to adopt more socially responsible business practices. Related party transaction. This is one of my favorite part of the proxy. It shows whether any of the company's officers or directors have the business relationship with it. Individuals that have business relationship with the company in theory may have trouble being impartial because there is potential conflict of interest. Tip. The proxy is so important to fundamental analysis that you can explore it more fully in chapter 9. Getting up to speed with the basic accounting and math. Even if you hated math in high school and avoided accounting in college, you can still put fundamental analysis to use. The more you dig into the financial of companies and see how math and accounting can help you, who knows, maybe you will be get curious to learn more, and if that's the case, you think look into business math for dummies or accounting for dummies. But here in this section I will give you the basic of what you need to know about the concept of accounting. You will see that accounting is really just a way to condense millions of individuals' business transactions down to a form that makes it possible for you to analyze. When you are studying financial statements, just remember there are three primary functions of business you are trying to analyze: operating activities, investing activities, and financing activities. Operating activities. Finding a smooth operators. A company's operations get the most attention. Typically, when you hear a company is or is not doing well, that is a reference to the firm's operating activities. Simply stated, a company's operations are the process of converting raw material into product that are hopefully sold to customers for a profit. Many elements go into operations, including effective new product development, which generates revenue, in addition to cost control, marketing, and manufacturing. The income statement explored more in chapter 5. Let's you see how well a company is operating. Investing activities. You have to spend money to make money. Unless they have found a goose that lays platinum eggs, all companies at some point must put money back into their business. Equipment used to make products wears out and needs to be replaced. Companies outgrow their headquarters and must acquire a bigger building. It's common for companies to overhaul their computer system to keep up with breaking their business. When companies spend money to make more money, they are investing in their future. And while investing in is a necessary part of doing business, it can also be done poorly. Companies might spend too much for equipment they did not need, or worse, they might overexpand, resulting in a glut of their product, which hurts their profit. You can read more about profit margin in chapter 5. There are two key things for a fundamental analyst to monitor when it comes to investment. Is the return on the investment adequate? If a company is spending money to expand and revenue and profit are not growing too, you might be throwing your money down the drain as investor. Is the company using the equipment it has bought? In business, having too much capacity is not a good idea. You don't want to spend money when renting a warehouse, for instance, if it's usually empty. Financing activities, getting in tune with high finance. So, you can understand how a company operates and how much it's investing in itself. But who's going to pay for all this stuff? That's the final and critical element that accounting helps you with. Generally speaking, companies can finance or fund their operations in two ways. They can either rustle up investors or they can borrow money. Investors provide money called equity capital to companies in exchange for a piece of the money. If all goes well, the company operates extremely well, profits soar, and investors are happy because their share of the company will be worth more. When you buy stock in a company, you are an investor. Technical stuff. Some beginning investors incorrectly think money they use when buying a stock goes directly to the company. That's not usually the case. Companies sell their stock to the public once in a process called an initial public offering or IPO. When those shares sell for the first time, the companies get that money. But after the IPO, the company does not get additional cash. The share and money are trading hands between other investors in the secondary market. Selling a stock is a great way for companies to raise money with no strings attached. The company sells the stock and the investors hand over cash. But selling a stock can be costly in the long run, especially if the company does well. When the profit comes pouring in, the original owners must share the profit with the shareholders. To avoid having to share ownership of the company, some companies might look to borrow money instead. Companies may borrow money from a local bank or sell IOUs called bonds to the public. Investors who lend money to a company simply want to get their money back, plus an amount of interest agreed upon ahead of time. If the company winds up doing fabulously well, the lenders only get the pre-agreed upon interest payment and not a penny more. The drawback, though, is that borrowers demand market interest rates and companies must pay on time or the company could go into default. Default is when a company can no longer afford to pay the interest on its debt and can lead to a company's filing for bankruptcy protection or even liquidating or selling off all its assets. Remember, if a company defaults, investors and lenders are treated very differently. The difference has a big influence on whether or not you decide to buy a company's stock or bonds. If a company is unable to keep paying interest to its lenders, the company goes into default. Typically, at that point, the bondholders take control of the company. In the worst case scenario, when a company cannot be saved, bondholders get repaid first. So, let's say a company defaulted and had a giant garage to sell and had a giant garage sale to sell a desk and chairs. The money would be used to pay back debt holders before stock investors see a penny. That means, as a stock investor, you are accepting the possibility that you can lose your entire investment. Learning to keep fundamental math skill percentage changes. If you have noticed so far, I have tried to spare you from much ugly math in the first couple of pages. It's time to start crunching some numbers. There is one math skill that you will encounter so frequently in fundamental analysis, you might as well tackle it now. That's the concept of percentage change. Because fundamental analysis is infatuated with looking at increase and decrease in business factors such as sales and revenues, the percentage changes is a way to put gains and declines into context. For instance, if I told you that the price of a sweater rose $40 this year, that does not tell you much. But if I told you the price was $60 before, then you know that the price jumped 66% to $100. You calculate a percentage change this way: new number minus old number divided by old number multiplied by 100. Going back to the sweater example, new price is $100 and then the old price was $60. So 100%. For those of you who don't think parentheses and math belong together, here is a mantra to help you remember it. New minus old divide by old. If you like the mantra better, follow these steps. New minus old, subtract the new number by old one, just 100 minus 60 or 40. Divided by old, take the answer from step 1 and divide by the old number, divide the 40 you got from step 1 by the old number 60, that's 0.67. Convert to a percentage. Take the answer from step 2 and multiply by 100, that gives you a 66.7% increase, which is the first from step 2 multiplied by 100. Remember, if a value rises by 100%, then it has doubled. Similarly, if a number rises by 200%, it has tripled, and 300 quadrupled. Some make the mistake, for instance, of seeing 2 in the 200 and saying it has doubled when it has in fact tripled. How to get the fundamental data you need? You might have the fastest car in the neighborhood, but you don't have any guess. You are not going to get far. So goes fundamental analysis. You might build the fancied financial spreadsheet, but it's not going to do you any good if you don't have the wrong financial numbers to put in it. Until the dawn of the internet, getting fundamental data could be a real hassle. You would have to call or write your company and ask it to mail. Yes, mail. It's 10K, 10Q, and annual report to you. Remember, thankfully, the days of having to deal strictly with paper financial statements are over, but the skill of the fundamental analyst must keep up with electronic age. In this section, you will find out how to quickly and for no cost get your hands on the fundamental data you will need to complete your analysis. Getting adequate with SEC's database. You can spend thousands of dollars for access to websites that provide fundamental data, but really, to get a start, you don't have to spend dime. The SEC website www.sec.gov is a treasure trove for fundamental analysis. You will find all the financial forms discussed above in this chapter and then some. All the fundamental data are stored in SEC's Electronic Data Gathering, Analysis and Retrieval or EDGAR database. You can use EDGAR to look up any public companies filing and even download the financial statement to your computer so you can do further analysis. A step-by-step directions on accessing company fundamentals using EDGAR. Now that you know how powerful EDGAR is, it's time to drive in and discover how to get what you need from it. For the example, I will show you how to get the 10Q, 10K and proxy statement for General Electric. Just follow these steps. First, log into SEC's website at www.sec.gov. Second, click the company filings link on the upper right hand corner of the page. Third, enter the name of the company in the company name blank. It's the first blank in the top page as shown in figure 4.1. Type in General Electric for this example. If you know the company's symbol GE in our example, you can enter that is in the first search blank. Fourth, click the search button. Fifth, choose the company name. Because General Electric has separate business units, you will see companies like General Electric Capital Assurance Company. But you want the main company, so click on the red numbers to the left of where it says General Electric Company. Sixth, click on the form you want. If you want GE's 10Q, scroll down until you see the form 10Q listed and click on the Documents button. If you want the 10Q, 10K, choose 10K and the proxy is marked as 14A. You will be taken to a page outlining everything contained in that file. Click on the red code under the document column in the first line. This line should have the form under the typed head, which is in this case is the 10Q. When you are downloading the 10Q, the line should read 10K. Technical step. When you are scrolling down through the list of forms, you might notice that some have a blue button that says Interactive Data. These forms are presented in a special format that computers can read, called Extensive Business Reporting Language or XBRL. Financial statements available in XBRL can be easily processed and downloaded. If you click on the Voluntary Interactive Data button, you will move to an area of SEC's website that lets you view financial reports using XBRL. You can easily skip between the income statement and balance sheet without scrolling. For instance, XBRL also lets you easily download the financial statements to a spreadsheet because it's not required to file using XBRL. Only a few companies do, but that's changing. Tip: most of the major web portals such as Yahoo at http have/finance.yahoo.com and Amazon http://money.amazon.com provide summaries of companies' primary financial statements. Most companies do put their financial data on their website, but as a fundamental analyst, it's important to know how to get the data direct from the source, the SEC's EDGAR database. Pulling fundamental data from websites into spreadsheets. Sometimes reading a company's financial statements using the SEC's EDGAR database is not enough. If you want to perform the analysis you will find out about in the next part of this book, you will likely to need to download the data into a spreadsheet. Tip: if the company you are analyzing provides XBRL data, it's easy to download into a spreadsheet. Luckily, there is a handy trick using Microsoft Excel all fundamental analysts should know about. While it's possible to cut and paste the financial data from a company's filing into a spreadsheet, the result can be a disorganized mess. Instead, use an Excel function that's built to order. Here is how. First, open the filing. Find the filing you are interested in downloading using the steps of copy the web address from the address bar in your browser by highlighting the address and holding the control button and the C. Second, open Microsoft Excel. Third, instruct Excel to find the filing. Choose Excel's data menu on the ribbon and click the Form Web option on the left side of the screen. A new window titled New Web Query will pop forth. Enter the web address of the filing into the new web query window. Paste the filing's address by holding down the control button and choose the V key in the address bar at the top. Fifth, import the filing. Click the Go button at the top of the new Wave query page in Excel. Sixth, select the relevant financial statement. Scroll down in the new Wave query statement window in Excel until you see the financial data you would like to download. Click the small yellow arrow next to the data, click the import button and then OK button in the import data window. After you follow this step, the financial information you want, such as the company's income statement or balance sheet, will automatically appear in a spreadsheet. This will be a handy skill that can help you with the analysis you would do later in the book. Findings, stocks, dividend histories. Dividends are periodic cash payments some companies make to their shareholders. The dividends are paid out of company's cash as a way of returning profit to shareholders. Dividends are a very important piece of your total return on an investment. Remember, don't ignore dividends. These cash payments over time account for about one third of the total return investors make on the market according to standards and Poor's. The remaining two-thirds of total return come from the stock price rising. During difficult time for the stock market, when stock price falls, the dividend might be the only gains you get. Dividends are also important ways to help value a company, as you will discover in chapter 8. Companies that pay dividends generally pay them quarterly. The best way to look up a dividend history is on a company's website. Nearly all companies provide an area of their website where payment history can be looked up. The Bing search engine can save you a step finding this corner of company's website. From Bing.com, enter the name of company and dividend history. Many times you will given a link that takes you directly to the company's website that lists all the dividend paid. You can also navigate to the dividend history by finding the investor relations section of a company's website. Going back to GE example, go to www.ge.com and click on the investor link at the top of the page. Next, click on the stock information link on the left-hand side. Scroll down and you will find the GE's dividend history, which lists GE's dividend payments going back for 2 decades. Getting stock split information. Money for nothing is hard to find on Wall Street, but sometimes investors get additional shares sort of when a company's stock price rises dramatically and begin to approach $150 a share or more. The executives might decide to split the shares in a stock split. The company cuts its share price, say, in half by cutting the shares into multiple shares. For instance, let's say you own 100 shares in a stock trading for $160 a share. If the company has a 2-for-1 split, you will suddenly have 200 shares, but they will be worth $13 a piece. Management feels some investors are more likely to buy stock in a company for $13 a share than $60. Then, the theory goes that some heavy investors who read too much into a stock's per share price might assume a stock trading for $50 or more is too expensive. Warning. Some investors assume that a stock split is a major boon because they suddenly have more shares. But as discussed in chapter 3, the per share price of stock does not tell you much. The value of your share is still $6,000 whether you own 100 shares at $60 or 200 shares at $30 a share. The company's market value also stays the same. Understanding when a stock split occurs is more important for fundamental analysis, though, because it can affect the number of shares outstanding, which is described in chapter 3. You will need an accurate count of shares outstanding to do some of the fundamental analysis later in the book. Fortunately, many companies provide stock split histories on their website, but not all do. And you might want to look up a stock split at multiple companies without navigating to several investors' relation websites. That's where other online tools can help you find when the split happened and how many shares were affected from it. Yahoo Finance helps you look up if and when a company is split its share. Here's how. Log into www.finance.yahoo.com. Second, enter the name of the company or symbol in the cute lookup blank and click on the blank name of company. For GE For instance, enter GE and click the General Electric link. Third, click on the interactive link below the charts heading on the left side of screen. This will take you to Yahoo Finance Advanced Charting feature. Fourth, choose the time frame. If you want to see all companies split in its history, choose Max. Observe the chart. If the stock has been split, you will see a small purple hexagon with the letter S in the center on the bottom of the stock chart. For instance, the chart tells you that GE last split its stock by 341 on May 8, 2000. Part 2. How to perform fundamental analysis. In this part, see how to thoroughly analyze a company and dig into its key financial statement, including the income statement, the balance sheet, and the statement of cash flow. Use financial research to help you quick and insightful information about companies. Discover how to unearth some of the more sensitive information about the company's management by using the proxy statement. This is the end of fourth chapter.